Hello, Mark Lowdy here at the IR Magazine Conference and Awards 2009 in Singapore. Companies gathered here today are looking for new ways to raise capital and reduce the cost of capital. Investor relations officers, chief financial officers are always looking for new methods, and one of those might be to tap into the increasing amount of funds that are flowing from US-focused investments to emerging markets-focused investments. And Tom DiVivo at BNY Mellon, you're a vice president there. You've actually conducted some research into those fund flows recently. What have you found?
Indeed we have. We found that fund flows into emerging market mutual funds have been tremendous. We've seen an inflow of approximately $52 billion year to date as of September 30th, 2009. At the same time, there have actually been outflows from US funds, US equities of approximately $60 billion. So the transfer of investment into emerging markets from US equities has been tremendous. And it's important to note, depositary receipts have been a very important part of that process. Indeed, we expect by year end, over $3 trillion worth of depositary receipts to have traded in either the US markets or the overseas markets in GDR form.
That's right, because ADRs is what we currently really know them as, American depository receipts, but they could be listed anywhere, can't they? So, but does that signal that there is a growing level of comfort, shall we say, among investors to be trading not the underlying stock, but a depository receipt, an IOU?
I would certainly say so. The depository receipt mechanism has been a very popular vehicle for companies to diversify their investor bases internationally. And again, as you say, historically, the depository receipt has been an American product, but year by year, as more and more companies use DRs to invest in markets or to list in markets such as London, Luxembourg, or even Singapore, investors from other parts of the world are becoming very comfortable with depository receipts as a mechanism for investment.
Is there any concern that depository receipts are issued by companies which wouldn't meet listing requirements?
I would say no, because most companies actually have a listing in their home market. So for companies that list on exchanges, whether it's the New York Stock Exchange, the NASDAQ, the LSE, the Luxembourg Exchange, or Singapore, those companies are meeting the requirements for those exchanges in addition to their local requirements. And for companies that have what we call an OTC or level 1 listing in the US, those companies again meet local guidelines. And in many cases, those companies are complying with local GAAP or their IFRS. I would say an investor that's investing in a level 1 as opposed to an exchange-listed company is well aware that the company that they're investing in is not meeting, say, US GAAP, for example. They're basically holding a level 1 ADR in order to have the benefits of having their security, their non-US security, held as a US security. And those could be for reasons of convenience of getting their dividends in dollars, reducing their custody costs, or just the simple fact of having their securities priced in dollars within their brokerage account.
So walk us through very quickly, step by step, as to what's involved for a company which, let's say, is listed already in the Philippines or in Singapore or in Malaysia. What are the step-by-step points that they need to take note of?
In terms of if they want to establish a depository receipt facility?
Yes.
They would contact, or we would probably contact them because we're very aggressive about contacting companies. We would suggest to them the different types of depository receipt facility available, and they would choose the type of facility based upon their own investment needs, their capital raising needs, and their corporate governance situation. To establish a level 1 ADR, it's very simple. It's approximately a 6 to 10 week process. We do a simple F6 filing in the United States, registering a certain number of ADSs that are allowed to be issued in conjunction with the establishment of that facility. To list on an exchange obviously involves more time and more expense. For example, if you're going to list on the NYSE or the NASDAQ, you have to have your accounts reconciled to US GAAP. You've got to comply with Sarbanes-Oxley. If you're raising capital, you obviously have to appoint an underwriter. So that can take anywhere, I would say, from 4 to 6 months to even up to a year, depending on how complicated the company's books are. But the level 1 facility is by far and away the most simple. And again, it can take as little as 6 weeks to establish, and just with simple filing. Provided, of course, that the company is listed on its home exchange and it publishes its financial statements and news releases in English on its website, its investor relations website.
All right, Tom DiVivo, thank you very much for your time today.
Thank you.